You're listening to the Practical Wealth Show with Curtis May, putting you in the driver's seat to control your finances. Let's start the Practical Wealth Talk about alternatives to Wall Street.
Thank you. This is Curtis May with the Practical Wealth Show, and I've got a very exciting show today, and I've got a special guest, Dan Zitowski, all right, and from Zitowski Capital Management. And so I'm excited to, so it's kind of the title of this episode is loosely creating wealth with real estate, but we're going to go, I get a feeling we'll go all over the place with this. But Dan, why don't you tell our listeners a little about your background, what you're up to now, and then let's, see if we can create some value for these folks out here.
Sure. I would love to. And thanks for having me on. I appreciate it. It's always nice to be on a show like this where somebody's actively doing the business. But rather than keep it long-winded about my history, my career in this business, I did start almost 28 years ago. I started a little different. I actually did start with a couple rental properties from money saved, and I was able to get an FHA loan. But at that point, I switched over and I got into like wholesaling and flipping at the time, flipping properties. And I was doing that for a long time while I was continually buying rental properties and buying land, some hotels and some commercial buildings. And I quickly started realizing that I made a lot of money in the flipping business or the wholesaling business. But the problem is I never actually created any wealth. So it got to the point where I was doing 30 to 40 flips every year continually for about 6 or 7 years when I got serious in the flipping business. And my flips were netting me no less than about $40,000. So we were making a lot of money at the time, let's say, well into the seven figures at the time on those flips. But what happened is we were just grinding. We were working ourselves 80 to 90 hours every week, 7 days a week. The stress was pouring out of my head. I was really getting nowhere. And all I did was create this monster and this job for myself that people see out there. And they think that's what's going to make you wealthy and it's going to make you happy in your life. And if you're all about just making a lot of money but not being able to enjoy that money with your friends and family to do what you want, when you want, how you want, then I'm all for it. There's a different type of investor all the way across the board. But I realized, like I said, and I've always bought rental properties, and I've always been a lender and been the bank. I've always tried to be the bank and collect passive income. But most of my income was coming from flipping or wholesaling properties. So I decided at that point, I said, you know what, I'm done really flipping properties. I mean, every once in a while, I went from about 30 to 40 a year down to maybe 2 or 3 a year. And most properties that I should flip, according to my numbers from the past, I've been keeping now. And if I do sell them, I sell them a lot of times on seller financing. I'll hold the note because I like to be the bank. I like to create that passive income and create wealth. But a big thing for me is really buying properties in emerging markets. And emerging markets is not my backyard, even though I'm here, so I buy properties where I live in Delaware or close by. But my emerging markets are markets where, and I've done a lot of episodes on emerging markets, it's markets where there's a lot of job growth, good quality schools, blue collar, working class people, low crime, infrastructure being put in place, highways. It's very landlord friendly, so you don't have to worry if somebody doesn't pay your rent. You're going to take 3 years to get them out. Like I said, it's rated high on like Forbes list, Inc. list, best places to invest, and the cost average per rent really comes in to make the return favorable return. So you don't have to go into a lot of people out there right now are getting some nice returns, some high returns, but they go into really low end neighborhoods. And the problem is they're putting the numbers together, but they're not actually looking at vacancy, maintenance, rehab, average length of time, a tenant in those neighborhoods. And if you get paid, it might be 9 months. Now, if you do Section 8 government programs, you have the guaranteed rent, but a tenant breaks through some issues, something in the property because they don't want to pay their small portion. Now you don't get any rent. So it becomes a management nightmare. I know a lot of people doing well with it. I'm not saying it's a bad business because if that's your business model, doing Section 8 government assisted program housing, it's great, but you have to make that your business model. You can't do Section 8, you can't do Class A properties, you can't be all over the place. And I would highly recommend if you're going to do Section 8 type properties or any kind of government programs, you're physically involved in the management of those properties, from everything from acquisition to rehab to managing the tenants, because that becomes a full-time job very quickly. And if you don't do it the right way, you'll spiral downhill even faster. So, like I said, over the last 4+ years, I've really expanded my turnkey rental operation. And what I do with that is I become like a wealth advisor to people. So I sit down and I love this is what I love doing more than anything in this business because to me, making money is not really hard in this business. Acquiring property is not really hard in the business. You see a lot of people doing it. But if you can sit down with an investor, somebody that's retiring or somebody that's just starting out with their family, and you can show them how to actually build up a portfolio that's doable. Most people don't realize they could do this. That's doable, and they take advantage of paying off the mortgage early on these properties, so they have equity to use equity on other properties if they want. They get the tax benefits, or they take the cash flow, or they set themselves up to pay for their kids' college education, or they can get their wife retired, or they can retire before Social Security. If they can see an end in light on their spreadsheet, on their balance sheet, that's really what I love doing. So yeah, we pick up properties for ourselves, and we own about 62 single family properties. We have a couple multifamilies, 152 unit building in Atlanta. We own two smaller commercial multifamilies in Cleveland right now. So, and all our properties are value add properties to us. And when I say that, it's more I buy the property in either distress, I buy a lot of non-performing debt from the banks or hedge funds, or tax lien. And it's also from sellers direct. But what I do very well is I set up teams, so systems, processes, and people in those emerging markets. So I will partner with property management companies. Now, I don't own property management companies. I don't want to own a property management company. And I believe you need experts on your side. Like I'm an expert in creating wealth for people in the real estate business. I want to have a property management company that has a full team in place that they can handle everything we need handled for our investors. So my investors come back to me and they don't have to worry or get those phone calls over and over again or get nickel and dime for any kind of maintenance fee. Now, can stuff happen? Sure. There's no guarantees in anything. But do you mitigate your risk as best as possible? That's what we do. And I like to invest in markets, like I said, with a better than 95% occupancy rate. Rents are very stable. Schools are good. Job growth is great there. It's not just one company in a community, and if they leave, you're dead. So there's multiple good companies coming in. Government actually is favorable upon corporations, so people, corporations stay there, and they create job growth, which creates rental properties. And even when the market tanks, like it did in 2007 through 2009, because I've been through 3 cycles. Even when the market tanks at that time, people will always need rental properties.
So you mean the market doesn't always go up? That's what, I'm going to, I tell people, look, appreciation is a bonus. You can't bet on appreciation. I tell clients, listen, if the price goes to zero of the house, people still paying the rent. Let me unpack a couple things. Well, you said a lot, and I don't want to take you off your thought, but I'm so excited to have you on the phone. But because one of the things that I try to share with people, and you hit them, see, because if you look at how people create wealth, so if you would, part of the essence of our show is that there's what I tell people, look, there's 2 schools of thought taught out there in personal finance, right? So it's the financial entertainers and the typical advice is, buy and hold, dollar cost average, get out of debt, buy term, invest difference, right? But if you look at the Forbes 400 and people that are successful like yourself, they don't do that. That's what I started to realize, that after about 15, 20 years, doing it the typical way, the way I was taught by the industry. And you look at most people that are on the Forbes 400, they build businesses and they buy real estate, right? And so I tell people, look, there's 4 asset classes: business, real estate, paper, and commodities. People buy oil wells, gold and silver, right? I met this guy that has coffee farms in Panama, that are cash flowing every year. And it's fascinating what's out there if you will expand your mind, And so what happens is, for y'all are listening, I want you to hear Dan's language, right? And so when he's investing, so I heard somebody tell me one time, listen, live where you want to live, but invest where the numbers make sense, right? And so he's looking at the world from a macroeconomic lens going, okay, I'm in Cleveland, I'm in Memphis, I'm in, Memphis. What's in Memphis? Federal Express. Where's the job growth? See, people, if you could get a cheap house, but if nobody's working, there's nobody can pay your rent. So there's got to be jobs there because as a business owner, what you're providing to the marketplace is safe, clean, affordable housing is your product. And so you have to begin to see the world as if you're providing a service to the community and begin to think. The other thing that you pointed out was that I try to teach our clients is that income is not wealth. Income is income. Income is good. I tell people, look, I can't steer a parked car. I do want you to have income, right? But wealth is how long you can maintain your standard of living without your labor, right? And so it's a function of time. And if you're, I would tell people, look, I know you've read Rich Dad Poor Dad. Do you know what Robert Kiyosaki, when the book came out, and he said, I was financially independent. I retired at 47, and my wife retired at 37. How much he was making when he said that, when he was financially independent? He was making $10,000 a month. He had like 100 something houses, and he was making $10,000 a month, but his bills were only $3,000 a month.
That's once you bypass the amount you need, your net operating expenses. Once you bypass that, that's when you're actually considered wealth. In my book, that's when you consider retired. So and then you have discretionary income above that. So when people are out there, they do these flips and they buy these high end cars. And I know because I did this. I'm one of these guys that everyone has a vice. My vice is high end cars. So you have high end cars, you have beautiful watches, you have boats, and I have them all, and I've done it all. But you got to the point where I was never, I'm never really happy. So and I realized I was making a lot, and believe it or not, I was making a lot more money then than I'm making now. But what I realized is I could do a lot less now, and my income now I make enough in passive income that if I don't ever work again a day in my life, I'm okay. I don't have to ever base my retirement on the government or Social Security. I don't have to worry about health care not being around or Social Security not being around and somebody to take care of me. I don't have to worry about my kids' college education because we've done it right. And there's a way to do it. When you sit down and you do financial planning, and we sit down with a financial planner and you go to him and you say, Mr. or Mrs. Financial Planner, I'm sitting down. I need to pay for my kids' college education. They're 10 years old. They're going to go to college in 8 years. I have no money saved. I have this little 401k at my job, and I make 4% or 3% or whatever I make at my 401k. Sometimes they do better. But they sit down and they say, okay, how do I save for my kids' college education? As a financial advisor, you sit down and you figure it out. Okay, you're going to need $300,000 to pay for their college in 8 years when they go. How much are we going to save for that? Well, you need to put away $30,000 a year for the next. And people they turn white as a ghost.
Right, exactly. That's impossible. And I add to that, in a market that's going up and down, that you can't do anything about it, that you can't control whether the market goes up or down, saving dollars, that the longer you have them, the less they buy. It's so many moving parts there.
Here's the other thing. I mean, I've counseled so many people, and I speak at some events nationwide, and I have some students that I coach, and everyone and I sit down with them, and I ask them all the time when they want to do a flip, and I ask them, well, what is their goal, and how much do you need to make on a flip? Most people don't even know what they need to make on a flip. So when you finally get it out of them, they're like, well, if I can make $10,000 to $20,000, I'm happy. Let's say you make $20,000. Let's go on the high end. Well, then the government gets their hands involved, right? So they're going to take about 40% from you. So now you're down to $12,000. But if they bought that same property, they wouldn't have to come up with nearly as much money. They can own that property. They might be able to get themselves a net rent of $500. In 1 year, that's $6,000. 2 years, they made more owning that property. And just I'm talking about cash flow. That's all I'm talking about here. They made themselves more in 2 years than they would have made on that flip. Now we start depreciating that property. Then we take, because there's four quadrants to rental real estate. Not the same four quadrants as Rich Dad Poor Dad, but the four quadrants are cash flow, okay, debt reduction. Those are pretty much that cash flow, debt reduction. Those are there. Rent increase, possibly, possibly not. and appreciation, possible, possible not. Okay, but you have the depreciations. When I say cash flow, I include depreciation in that. So you have those. Those are kind of guarantees. Those two are guarantees, and the other two are maybes. But even if you buy a property for $100,000 and somebody pays that mortgage off for you, and the property in 30 years is $100,000, you created all that cash flow, all that depreciation, you still have $100,000. Okay, where in investing in mutual funds and IRA, mutual funds and stocks, you might not have that. You just might or might not. It's just the way it is. But you could also, what you can do with real estate is so much greater because you have equity in a property. You can use that equity in a property to expand and create wealth. You and I sat down, we showed like a reverse amortization schedule. Now you can pay these properties down in literally less than 7 years on a 30-year mortgage. So you can buy a property in a good market. Like we're very heavy in Alabama right now. Alabama's a phenomenal market. Certain parts of Alabama in certain communities, and we're a Class B to B plus area. We don't even touch C's in Alabama. At worst, it might be like a close to a B minus. So very blue collar, very blue to white collar area. Working class people around all the companies that have, Mercedes, Publix, all these companies that have moved there. Okay, so we tell people, well, you can get if you're mortgageable in your personal name, you can get a mortgage with as little as 20% down. Well, we're talking about properties from the $80,000 to $110,000 range. So for all in, you're at $20,000, $25,000 on the property. How do you do that anywhere else? And then start seeing a return after all expenses, including vacancies, the maintenance, all expenses. You're seeing like 14 to 20% return in that kind of market if you can get a mortgage.
With cash flow, because what happens is what I find is that with a lot of people, you'll say, I'll ask them terms just to see if they're thinking. They don't know their numbers. You say things like cash on cash return, and they look at you like you're crazy. Some of the newer ones, it's, oh, I got it cheap and I'm going to flip it or do whatever, but they don't bring the level of sophistication that you're talking about building a portfolio. And we talked about this. It's funny because we were having coffee the other day and we were just getting all hyped, going back and forth. I was like, wait a minute, we need to record this. So I said, all right, we're going to record this. And we didn't have any agenda today. We're talking, this is all freestyling because we could both go. We might cut this up into two and we keep going. But what the interesting thing was, and this is what I share with people. I have a client, and I'll show them. I say, listen, this is what I'll do this at workshops. I'll say, listen, if you want $100,000 worth of stock or mutual funds, let's say, I'll ask them, how much money do you need? And first they look at me. I say, it's not a trick question. You need $100,000, right? And so, but if you want $100,000 worth of real estate, how much money do you need? And they'll go, someone will say, well, I'll need 20,000. The true answer is it depends on your skill set, how much you know the situation. But let's say worst case, so if you had 100,000, what the example you showed me, this is one of the things that we're going to work together to teach our clients, Dan and I, and help them build real estate portfolios. So it's like a person would build a mutual fund portfolio, because if you could get you could get 5 properties, you say that for the same money. And so what happens is, I was talking to one of my clients and said, listen, if you could, let's say just on lowball, you could net $400 a month after all the expenses of the property, right? And you did 2 of those a year for the next 5 years. That's $4,000 a month, right? That's like having an equivalent of having like $1 million in a 401k in terms of cash flow. Like if you could get 5%, that's what, $50,000 a year off of your million. That's $4,000 a month. But it might take you 30 years to do that, assuming there's no market corrections where you all of a sudden you think you're up 700,000. Well, I got 300 to go, and all of a sudden we have another 2007, and now your money is halved or down 25%. And what people don't realize was, if you got, just to keep even numbers, if you got $100,000 and you have a 50% market correction, you need to earn, or that fund manager's got to get you 100% just to get even. You haven't made no money yet. You just are even. You know what I mean? And so what happens is people see his prospectus. Oh, I did, such and such return. But what happens is that's 10 or 15% on the 50,000 you had left. That's not on the 100,000. So you're still behind. It's going to, you get 10, 12%, it's still going to take you 6 or 7 years just to get back where you were. And so people don't really understand the game they're playing.
100%. It's such black and white with people. They don't understand how to really expand their mindset and really look at this. I don't blame them. They're not taught this in school. You can't imagine how many people, including, I have some of my own family, when we talk about retirement, I ask them, okay, where's your money? Well, it's in a 401k. Okay, that's not where your money is. That's a vehicle to use to invest. Well, it's with this advisor. Okay, what is it in? Well, it's in a mutual fund, 30-year mutual fund. Great. What are they buying in that mutual fund? What kind of equity, what kind of stocks are in there? What's in that mutual fund? So people just don't want to take either responsibility, or they don't want to get outside their comfort zone because they were never taught how to manage their own money. They figured go to a financial advisor. And once again, I'm not going to say all financial advisors are bad, but I know a lot work for certain banks and certain companies, and they sell what the bank tells them to sell or what makes them the most commission. They're putting people into annuities that shouldn't be in an annuity because those annuities pay very high commissions. What I love about what you're doing is you have a plan. You're putting them into a policy that they could actually borrow against that policy to create wealth for themselves, but still be protected. God forbid something happens, so them and their family is protected to cover their losses and to cover their income. That's where it's huge. That's what makes a difference because your approach is so much different than every other person that sells insurance. They're putting people into a policy that's just going to net them the highest returns over and over again, but it doesn't help their needs.
And they think that that's, like I was talking to a guy yesterday. He was telling me how this policy. So for y'all that don't know, I'm a kind of insurance-based financial advisor, and the core strategy that we teach is we call it the private reserve strategy, or being your own banker, right? And so banking, not that you're talking about creating a bank. Banking is just creating a pool of capital that you control that can move at cost to meet some needs you have. And so one of the things that we teach in the prosperity economics movement is permanent life insurance, whole life, dividend paying whole life, structured properly. Okay, that's a whole pod. We'll record a separate podcast on that. Is the best place to store cash, but it's an and asset. Like, it's not, should I do this or that? Because what you can do is you can collateralize your cash values, and then you can use them to buy real estate, to buy cars, to use them for college. You can use them, we're taking a policy loan out, we're going on vacation. And then what happens is I will pay my policy back or myself back with interest and recapture that money while my money is still making money for me. And it's insurance. So if something were to happen. So, one of the things we talk about is you got to learn to create velocity with money, right? And so that's one of the things that we do there is we create velocity we call creating velocity with simultaneous use, right? And so, one of the questions I ask people is, where do you store your cash? Because it's not an investment vehicle, it's a savings vehicle. And then, let's say you can get 4% in it. Well, anytime you can find something that pays more than 4%, then go get it, but it's there. And that's the power of it, combining it with what you're talking about. It's like, oh my goodness, it's well, we're preaching to the choir here, but
We had a great napkin conversation. If you remember, we talked exactly about this the other day, which I'm not going to talk about here because if I can't sit there and draw it out for your listeners, it's not going to really benefit them as much. But
right, that's a webinar. We'll do a webinar where you can draw it out.
yeah, either a webinar or anyone comes to some of those meetings that we plan on doing for them, um, we'll blow them away on how to really pay down all their debt the right way and how to actually take advantage of what a bank takes advantage of you doing. People don't realize that. I ask people all the time. They're in their mortgage, 30 years, and they might have 10 years left. And I go, "What's your interest rate?" And they go, "Oh, it's a good rate. I got a 4.5 or 5%." And I go, "Do you realize you're probably paying about 15% on your mortgage?" And they're dumbfounded. They turn white. They have no idea what they're talking about. But what's so cool about rental real estate, rental properties, obviously in good markets and with a good team, is not only you making, let's say, 14 to 20% yield cash on your money, but the reason it goes up every year, and people don't understand this, and it just boggles my mind. It's like bananas out there. What people don't understand is that, okay, year one, you might have borrowed $80,000. Okay. Year two, even if you don't pay this mortgage off early, year two, maybe instead of $80,000, you owe $78,000. So your spread so your return might go from like 15.9. I just did something today. I have an investor that's buying out 3 properties this week. So I just did something with him today. I did an amortization schedule over 30 years. We started at 15.9%. By year 30, he's at 35.09%. I'm sitting here looking at it in front of my screen. Year two, it's like 16.21 because the differential between debt, how much is owed, and how much he's making increases his return because of the principal reduction. Think about it. So you borrow $200,000 from a bank, and in, let's say, 20 years, you owe $50,000. Well, that bank hasn't changed that payment that you're paying them. They got that money back and they're recycling it. They're using velocity of money. They're taking your money, lending it back out at 4 or 5%, but you're still paying your mortgage payment of $1,500 a month, even when you only owe $50,000 now. Does that make any sense? None at all. So you have to get in that's what happened to me years ago. I got in the banker's mindset because I am a licensed lender. And years ago, I said, I'm going to figure this out. And I like being in the bank. I said, it's horrible doing what I'm doing. I want to be the bank.
And that was a mind shift change for you. See, because that's the thing. See, we're taught to be customers of the bank, but you got to learn to think like the bank. So like a loan for a bank is an asset. We view, we still think we are always paying loans, but it's an asset to them. So and it's putting money to work. And so that's the power of that. And then you're buying assets that's cash flowing not using very little of your money.
Well, think about it. And you think the bank sits there and when they give you a $200,000 mortgage for 30 years, do you think they sit there and every mortgage payment you make, they put it on the side and put it in a savings account? They're making money on that 10 times over and over again. And you don't realize. So when we talked about how to pay off your mortgage using a line of credit and have that, financially, it's not really the smartest move in the world to pay off your mortgage. But when you have a line of credit and you do it with a line of credit and you can keep using that money over and over and over again, and you can reduce the amount of interest you pay every time you make a principal payment, it's mind shift. It's a mind game, and it's a game changer. I mean, we've showed people how I pay. I mean, I've sitting there and I own, like I said, I own 62 rental properties. I have 3 mortgages left, and literally my mortgages are under $50,000 across the board on those 3. So I sit there and I teach people. And you know what? On my mortgages with the 62 properties, I started off with 30-year mortgages on most of them. And I didn't sit there and I didn't do this bi-weekly junk that people do. I didn't take a little bit of money and pay it on each mortgage every month. I focused on one property at a time, and I got paid off. And we did this in all less than 10 years. Obviously, I'm a very aggressive investor. And when I say that, I mean aggressively meeting my goals. I'm not aggressive like a bit. As crazy as it sounds, I'm not a huge risk taker. I mitigate my risk as best I possibly can. And I'm a due diligence freak. And anyone who invests with us understands that. But like I said, I went to an event yesterday, met 2 of my investors that were there. They're telling everybody how great this is, but they haven't gone and refied out their properties to pull money out and buy more. And the new investors that wanted to buy properties in the Cleveland market where we were in, I told them, I said, honestly, I can get you properties there, but for the same price, we're going to lower the quality of property we're getting into because the market's gone up.
Thanks for listening to this episode. Because this is such a great conversation, we've turned it into 2 episodes. Stay tuned for the second half of the conversation in the next episode.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.